Good morning, everybody. It's January 20th, 11 a.m. here in Long Island. We had some dusting, some snow, a couple of inches over the weekend. No big deal. It was a good football weekend, and obviously there were some controversial plays in one of the games, especially. But Let's turn to the games of the day, and that's the geopolitical games. It's if it wasn't so serious, it would be like hilarious. I mean, we're talking about a situation that kind of reminds me of a Peter Sellers movie. I think it was called "The Mouse That Roared," and it was about some little dinky nation that was selling wine, and then that wine was suddenly made in California, and so they lost their only means of income. And so Peter Sellers, I think he was the foreign minister, came up with the idea of why not start a war with the United States? Because countries that start wars with the United States always get supported when they lose. It's that's a hilarious movie for sure. But how does this have any relationships to what's going on today? Well, it's not the mouse that roared; it's the mouth that roared. Donald Trump has been roaring quite a bit about Greenland, and now is threatening to slap tariffs on the European Union countries that are coming to the defense of Denmark's sovereignty over Greenland. And It's what could really be hilarious today, if it wasn't so serious, of course, let's be serious about this, is that the Supreme Court, who knows, maybe the Supreme Court will decide today that these tariffs are unconstitutional anyways. So then the administration will have to scramble and come up with some other ways to justify these tariffs. At any rate, it's pretty clear that the administration is serious about Greenland. Maybe it'll be renamed Trumpland when and if it becomes part of the United States. But There are serious geopolitical issues involved with Greenland and national security. I'm not privy to them. Just whatever's in the press, you can kind of glean. And there probably is going to be some sort of deal worked out. Let's keep in mind that Donald Trump's background is in New York State, in New York's real estate, in New York City real estate. And The way it works in New York City real estate is, when they have to negotiate, you get the developer come into the room, you get the labor unions, the zoning people, the politicians, and they're all screaming at each other, bullying each other, threatening each other. And then after a few days of that, suddenly it's quiet in the room if you're listening outside from the closed doors. And then all of a sudden the closed doors open up and they all come out with big smiles on their faces, shaking hands and say, "We got a really good deal. It's win-win for all of us. We're all very pleased with this deal. It's a good deal." And so that's the kind of background that Trump comes from. And so I think the markets learned last year, maybe not. The markets should have learned last year that when Trump huffs and puffs and threatens to blow the house down, that's a negotiating style. And there was certainly a lot of Swiss cheese in the tariffs of last year, a lot of holes in all those deals. And I think we're seeing again the past couple of days with Trump throwing tariff threats at the EU again, that this is not, tariffs are not a done deal as far as he's concerned. It's a negotiating tactic. But we'll see. I'm not expecting a military confrontation between the U.S. and NATO and Greenland, there's bound to be some sort of deal. But it is a dangerous situation to be serious about it, in the sense that the Trump and we wrote about it. William Pesek wrote about it in today's morning briefing on the geopolitical consequences of Trump. Um, he had quite a bit of success in uh, hopefully eradicating the nuclear program in Iran, though obviously they're going to try to start it again. And obviously they still hate us. And obviously we still don't like them. Uh, and he had quite a bit of success in extricating Maduro, that though the government still has a lot of people. I mean, all the people that had been in the government are still there. Maybe they're just more willing to listen to what we have to say now that Maduro's gone, and we've demonstrated our ability to take them out as we please. But reiterating the Monroe Doctrine to the Western Hemisphere and saying, well, it's Latin America, it's Greenland, it's maybe Canada at some point. Uh, that all must kind of raise some questions about what's the reaction going to be over in Russia and China. What is clear? There's clearly a Putin doctrine, which is that Ukraine is Russia. And oh, by the way, there's some other parts of Eastern Europe that are parts of Russia too in the Putin doctrine. So uh, clearly, this dramatically reduces the likelihood that Putin is going to be willing to negotiate a deal that leaves Ukraine alone, um, and that doesn't continue to push against other European countries like the Baltics. Over in China, there's got to be hardliners that are recommending to Xi that now's a good time to take over Taiwan. Why not? I mean, the United States doesn't have much credibility in telling China not to take over Taiwan. Um, but then again, as William laid out, there's a lot of reasons for not doing that, and you know, but I don't know. Well, but it certainly raises some geopolitical risks there. Now, having said all that, let's have a quick look at a chart that looks at geopolitical crises and um, and the stock market. So this is it here. Let me just see. I got a comment here. I want to make sure. The Supreme Court has kicked the can down the road. No ruling on tariffs. Next possible ruling date is February 20th. Okay, thank you for that. Okay, see, we do this in real time. So much for the SCOTUS doing anything today, or I guess the next time is February 20th. I guess they must be thrashing it out. Um, Anyways, it is a complicated issue for sure. But here's a chart of the S&P 500 going all the way back to the 20s, and you can see that we've put bear markets into that chart. We've also put boxes showing major geopolitical crises. If we miss some, let us know. But the Smoot-Hawley tariff clearly was not a opportunity to buy stocks. As you can see from that chart, the so-called Great Crash really started with the Smoot-Hawley tariff. It didn't really start in late 29. Late 29, the market there's some inclinations or implications from the news at the time that the market was starting to get wind of the Smoot-Hawley tariff, but it clearly was overextended, had a significant sell-off in a short period of time, but then it recovered, and by April of 1930, it was back to where it was the year before. So I mean, that's no big deal. We've all had that kind of experience without wanting to jump off a building. But then the Smoot-Hawley tariff was passed, and we have lots of charts showing commodity prices taking a dive, uh, uh, delinquencies on loans, particularly the farmers taking dives. And here you can see the stock market took a tremendous dive. And so there were other factors behind the Smoot-Hawley, behind the Great depression, but the Smoot-Hawley tariff really got things kicked off, and it really caused a tremendous crash, great crash in the stock market. Germany invaded Poland, as you can see, and was another geopolitical event which weighed on the market. So that wasn't the time to buy. The idea is that geopolitical crises have a history of being opportunities to buy more often than not. But when they're not, it gets pretty ugly. But here you can see Pearl Harbor occurred, and only a few months after that, the United States took a big chunk out of the Japanese Navy in Midway, and that actually made the bottom because investors started to perceive that, you know what, as shocking as Pearl Harbor was, we're gonna win the war, and so the market rallied. Then North Korea invaded South Korea. That didn't seem to affect the market much. Suez Canal crisis, no big deal. Cuban Missile Crisis, a big deal for a little while, but again, a buying opportunity. Six-Day War, Yom Kippur War, they were more troublesome because they led to the surge in inflation, which caused the Fed to raise rates. So there clearly were significant bear markets related to that. The Iran Revolution, not really much of a opportunity there, didn't go down. Iraq invades Kuwait. Then we have the the crisis of 9/11, the horror of 9/11. But again, it was a few months later that the market bottomed. And then more recently, we've had the Russia invading. I guess I should. I mean, the pandemic was a geopolitical crisis, but the Fed poured liquidity, so it didn't. It was a buying opportunity for sure. Russia invaded Ukraine. Oil prices went up. We had a bear market. Turned out to be a buying opportunity. And then Hamas attacks Israel. There's a terrible war in the Middle East, and the market's doing really well. So that's just a chart on that. We got some other fun charts to share with you. Let me see where I wanted to go with this. Oh, yeah. So where are we now? Well, we've got this geopolitical crisis. Maybe it'll turn out to be a non-event. I mean, I hope you bought this morning because maybe that was it. Maybe that was the extent of the geopolitical crisis. The market has already figured out that geopolitical crises can create buying opportunities. So maybe there's lots of investors that have already figured out that this morning was a buying opportunity. But of course, that's not the only crisis that's out there. There is a debt crisis out there. Ray Dalio has been going around for a few years saying that a debt crisis is imminent. Maybe he should be doing that in Japanese, or maybe should have been doing it talking about Japan rather than the United States, because we really haven't had a debt crisis in the U.S. yet. We came kind of close in 2023. Remember when the bond yield went from 4% to 5% in 3 months? It was Bill Ackman made a fortune on it. He's a smart guy, and I think he shorted the bonds in early August of 2023 and covered in November 1st, or at least that's when he announced on social media that he covered, and that was basically from 4 to 5%. He was short, and then he covered. Well, on November 1st, Janet Yellen, and we talked about this before, Janet Yellen, Treasury Secretary, basically told the bond vigilantes, okay, I get it. You don't really want me to increase the issuance of bonds. I do need to raise more money, and I'll do that in the bill market. And that helped to calm things down because suddenly the bond vigilantes were reminded that they're not the only players in the bond market. The Fed's a player, and with QE and QT and what it does with the Fed funds rate, but the Treasury can also play yield curve control and decide where it wants to raise its money. And if the bond vigilantes get too uppity, then the Treasury could always say, well, okay, we'll finance more in the Treasury bill market, and Treasury yields are below bond yields anyway, so why not? But meanwhile, in Japan, the inflation has been picking up. The Bank of Japan has been raising interest rates, but the economy is kind of looking weak. So the new government is talking about imposing more fiscal stimulus, and there's going to be a snap election to try to get more power for the government, which they might get because if you tell the voters that you want to stimulate the economy, they may respond and may not really recognize that by doing that you're creating havoc in the bond market there. And so you can see this is the Japanese 10, 20, 30, and 40-year bond yields, and it isn't a pretty picture. And the question is, will something break? Usually, when interest rates move like this, something breaks. Maybe it's the famous yen carry trade, but wasn't it like about a year ago that we had a stress test of the yen carry trade, and it's kind of was a 1 day sell-off in the stock market, and that was kind of it. So I mean, the people who are playing the yen carry trade, they're pretty sophisticated people. They know kind of what kind of danger they're facing. Um, so I'm not sure that the yen carry trade is suddenly going to be the kind of the Lehman moment that people might be worrying about. But look, I've said that I thought that the first half of this year could be a little tricky, could be a little volatile, and so far that's the way it's playing out. It's also playing out in a way that's supportive of the call we made December 7th of last year. We just updated that call on January 18th in the quick takes, and you can see that the title is "So Far So Good for our rebalancing call." And the fundamentals are there for the market to broaden out. This is the percent of S&P 500 companies with uh, positive 3-month percent changes in forward earnings and forward revenues. And so that's looking solid at around 80%. Earnings expectations are improving, and it's not just for the Magnificent Seven, it's spreading. This is a chart we showed on is it a bubble and is it going to burst? This is the S&P 100 to the S&P 500, and this is what happened back in the tech bubble and the tech wreck. We had a burst, and we seem to be heading in that direction, but maybe not. Maybe this is a head fake. Maybe the fact that the market's broadening out from the S&P 100 to the S&P 400 is a good thing, and it's going to continue, and that's kind of our position. If that's the case, instead of having a bursting bubble and a bear market and a recession, we'll have just some air coming out of the tech sector and the Magnificent Seven. This is a similar chart. This is the S&P 500 market weight to equal weight, and this is what happened back in the tech bubble, how high it got. We're not even close to that this time around. So again, this tech bubble thing may turn out to be another panic that false panic. This is just another chart of the S&P equal weight to market weight. The equal weight is at an all-time record high. This is the kind of action we'd like to see. We'd like to see the market broaden out, and it seems to be doing it. But again, admittedly, there have been head fakes. On December 7th, we said, look, the tech and the communication services are now 45%, 46% of the S&P 500. We kind of said, well, maybe it's time to stop recommending overweighting these two sectors since they already account for so much. Now we are equivalent in terms of market cap share for these two sectors to where we had been back during the tech wreck. The difference is this time around, the earnings share is much stronger than it was back here. So, maybe jumping the gun here on lowering expectations for this sector. But all we really did is said we're not going to market overweight it. We're just going to market weight it. So it's not like we're telling you to, get out of these sectors. And meanwhile, we're kind of on the tech sector. We'd maybe underweight, and we have recommended underweighting the Magnificent Seven. So that's certainly a call. maybe a significant call, or maybe just an erroneous call, but we would stay with semiconductors. Yeah, and if you want NVIDIA, why not? That's what you get when you get if you put it in an index for semiconductors. This is one chart we'll be tracking to see if we're on the right path here. This is the Magnificent Seven ETF divided by the XMAG, the 493, and that's heading in the direction that we called back here. And by the way, this peak was right around when Michael Burry in on October 30th tweeted that maybe it was time to bet bet on this bubble bursting. Uh, I think he did us a favor. I think by letting us kind of recognizing that there's some excesses going on in the Magnificent Seven, that kind of reduces the potential for that suddenly to burst. I mean, usually things burst when you don't expect them to burst. So we'll see how that one goes. Meanwhile, again, this could be a head fake, but the S&P 600, 400, and the Russell 2000 are showing some signs of finally outperforming, but there have been lots of fake outs for quite some time in this area. But we are seeing some better earnings for the mid caps finally after being sort of comatose. Valuation multiples certainly justify putting some more money into mid caps. Rather than overall mid caps, we've been recommending overweighting the sectors we like in the large caps. So industrials have done extremely well. Financials, not so much because of the 10% credit card cap. But, Trump, he's got a loud mouth and says a lot of things. I'm not being critical. I'm being objective, not subjective. He talks a lot. And sometimes he kind of stops talking about things. So maybe he'll stop talking about the 10% cap on credit cards. We'll see. Meanwhile, as I said, the earnings story, S&P 500 forward earnings going straight up, looking like they're finally making a new high here for the mid caps and the small caps. Jury's out, but at least they're going in the right direction. Anyways, the stocks that have done well in the mid cap arena have been the ones that are losing money rather than ones that are profitable. So go figure. That's the way the market operates. This you can look at on your own, but year to date, this is the outperformance of the small caps, the mid caps relative to the large caps. And that's a lot of that because the magnificent. Let's look at that. I forgot to mention that in this write-up, but the Magnificent Seven were actually down year to date. Meanwhile, as I said, we got the 65% of the market cap of the MSCI in the rest of in the U.S. for the all country world, and you can see that the percentages in an emerging market is 11%. So if I'm telling you to overweight it, that's not saying much. Question is, do you go for 22% of your portfolio? You make that decision, but I think emerging markets should emerge as they did last year. They're cheap. This is the forward PE of the U.S. MSCI versus the all-country world, excluding the U.S. And so the rest of the world is cheap. The rest of the world, though, keep in mind, tends to trade like S&P 500 value. So it does tend to historically trade lower, though back here it was kind of trading the same. I think that's all we want to go over in the monologue here. Let's open it up for a little discussion. So let me go to so far I've only got one comment, and that is about the Supreme Court. Anybody want to ask anything or object, say anything, whatever you like in the Q&A? Well, we could call it a day if I don't get anything. I'll wait 10 more seconds. 10, 9, 8, 7, 6, 5, 4. Three, two, one. Well, I guess everybody's busy today. But we did have a nice turnout. I appreciate that, even though we changed the date from Monday to Tuesday. Um, let's it should continue to be an interesting week. Maybe now the Supreme Court issue isn't going to pop up out of the blue. We know it's going to be postponed until February 20th. We'll see what happens then. Thank you, everybody. All the best.